Gold is approaching a massive liquidity zone where smart money is gearing up for its next major move. Right now, our primary focus for this explainer is a very specific sell setup resting just above key liquidity, but there's a catch. One strict condition has to be met first. Most retail traders are honestly staring at the completely wrong level right now. So let's break down exactly where institutions are actually pointing their crosshairs.
Instantly, here is the ultimate downside objective for today's session. The 3950.55 sell-side liquidity pool. That right there is the true draw on price. We're not in the business of guessing here. We're strictly tracking the heavy footprints of institutional order flow. But here's the problem. Most retail traders just see a chart full of random candles, or they're desperately trying to catch a falling knife to buy a perceived discount. To actually capitalize on this setup, you have to stop and ask, where is smart money actually positioned today? Are they really accumulating to push prices higher, or are they just engineering a trap to distribute even lower? Okay, let's lay out today's blueprint so we have the framework locked in. Our daily bias, strict bearish continuation. The exact setup we're hunting is a sell execution, but only after price sweeps that key buy side liquidity. And as we just established, the macro target is 3950.55, the sell side liquidity resting quietly below the current structural lows. Now, zooming out to the daily time frame, the overarching narrative is crystal clear. We are deep inside a multi-month bearish distribution phase. Ever since that major high earlier this year, the market's been locked in a macro selling program. Notice how every single minor bullish pop gets immediately slammed with aggressive institutional distribution right at premium arrays. The algorithm is structurally delivering price lower, driving it into deep discount territory to sweep out those older historical liquidity pools. And this is where it gets interesting, because that macro bias fractures perfectly down into the intraday timeframes. On the 4-hour perspective, there's sustained bearish institutional order flow, back-to-back structural breaks to the downside, flawlessly respecting lower swing highs. Step down to the 1-hour, and it's the exact same story. After a brief relief rally, we printed a definitive market structure shift right back to the downside. Bearish order flow is absolutely in the driver's seat right now. So where exactly are we looking to enter? Well, the strategy demands precise structural alignment. Our prime area of interest is sitting tightly between 39.95 and 40.05. Why? Because this zone used to be structural support, got violently broken, and now it acts as a massive bearish breaker block. Plus, it lines up perfectly with an open 1-hour bearish fair value gap. This combo creates a high probability premium array. It's exactly where smart money is most likely to step in and fiercely defend their short positions. But hold on, the market is flashing a major warning signal right now. Is this trade actionable at this exact second? Absolutely not. Our execution status is strictly wait. There is zero institutional confirmation yet. Right now, price is sitting way down in the discount portion of the immediate dealing range. Hitting the sell button here means you're selling the curve low, and honestly, that's a fatal error. To execute safely, you have to follow a rigid step-by-step protocol. First, wait for the New York session news to engineer a clear liquidity sweep. Second, we need to see price aggressively spiked up into that premium fair value gap and breaker block between 39.92 and 4,002. Third, and do not skip this, don't just blindly hit sell. Wait for a 15-minute market structure shift with strong displacement back down. Only then do you pull the trigger, targeting that 39.50 major swing low. Moving into the 15-minute time frame, this is our microscopic execution environment. There's an open fair value gap between 39.88 and 39.95. The setup requires a classic Judas swing. We need a false move, a deliberate spike designed to fake out early retail buyers and engineer liquidity to shoot right up into this precise zone. We want those early New York minor highs totally swept out before the real algorithmic drop begins. But here is the critical scenario that the vast majority of traders are completely blind to. And frankly, this is exactly where most of them are going to get trapped. Consider the current price action, sitting around 39.70. Retail traders are staring at this, seeing a classic double bottom. They're eagerly trying to buy this so-called support. But by doing that, they are building up a massive, dense cluster of stop losses right below 39.70. The institutional reality is much darker. Smart money, holding massive short positions, will inevitably drag price down just to sweep those exact stops. The cruel irony here is that retail's perceived support is actually the institution's primary target. So how do the institutions actually trigger this sweep? Simple. They weaponize today's macroeconomic data. The calendar is packed with a heavy cluster of high-impact events for the New York session. In the world of smart money, these data drops aren't just random economic reports. They are the exact liquidity catalysts the algorithms use to justify rapid repricing.
We've got US ADP employment data, Fed speeches, and ISM manufacturing numbers all hitting today. And the broader macro context heavily supports dollar strength, which inversely means gold weakness. Geopolitically, the stalling US-Iran peace talks in Doha are keeping safe haven demand for the dollar super elevated. At the same time, easing supply fears have pushed WTI crude oil prices down, weakening the Canadian dollar and giving the US dollar index even more juice. Throw in a 63% chance of a Fed rate hike this September, and the fundamental backdrop is perfectly married to our technical bearish bias.
So it all boils down to timing. Here's how we anticipate the manipulation will play out chronologically. During the London to early New York transition around 10 a.m., expect a slow, agonizing consolidation just to build up buy-side liquidity. Then, at 7:15 p.m., ADP data should inject the initial volatility to kick off that Judas swing higher. By 8 p.m., during the Fed speeches, the analysis expects the ultimate lethal liquidity sweep right up into our 4,000 level zone. Finally, at 9 p.m., ISM data hits, serving as the catalyst for the true institutional displacement lower. When you stack it all up, the strict alignment of the daily trend, the 4-hour order flow, those massive structural liquidity pools, and the macro catalysts, the source gives this bearish setup a massive 85% confidence score. The probabilities heavily favor a sweep of premium arrays, followed by a ruthless distribution straight through the session lows.
All right, let's do a rapid-fire recap of the exact trade parameters. The execution zone is tight, resting between 3992 and 4002, awaiting that critical 15-minute confirmation. Your hard invalidation level, meaning your stop loss, has to go securely above the 1-hour structural high at 4016. The game plan takes partial profits at 3970 once the retail trap is swept, leaving runners for that macro 3950 target. And most importantly, keep your risk management completely dialed in. Do not risk more than 1% of your account on this setup.
Understanding how to read these institutional footprints really strips the emotion right out of your trading. Now, if you value this level of high-grade market analysis, the author of this breakdown notes you can subscribe to the ICT Market Theory channel. And if you are looking to trade alongside setups exactly like this one, you can find the FXTM broker link right down in the pinned comment below. The algorithms are infinitely patient. They will wait for the absolutely perfect millisecond to execute. So the question you have to ask yourself today is this: will you lose your discipline and get caught in the massive retail liquidity sweep at 3970? Or will you wait calmly for the true institutional shift at the premium highs?